or half of gold demand is used for jewelry every year. If you take half the market cap of gold, that would equate to roughly 500K Bitcoin price.
So in my view, honestly, we are past 70% drawdowns. I don't think it will happen again.
I think most people are surprised by rising Bitcoin dominance. If you're a tech company and you can't beat 17, 18% internal rate of return with your own capital, then what you can see from the performance of all these Bitcoin treasury stocks is the market kind of saying, hey, have you thought about Bitcoin? I still think 50 to 70% of an on-chain exposure should be to Bitcoin. And then no other single holding should be more than...
Welcome to the Verified podcast by Bitcoin Suisse, your backstage pass to the world of crypto. We host some of the biggest names in digital assets to cover the latest trends and share insights not only for your entertainment, but for the love of the industry. None of the discussed is financial advice, of course. It's all for informational and entertainment purposes only. So sit back, relax, and let's dive in.
Welcome back to Verified. Welcome Matthew Sigel back on the show. Matthew doesn't need a super big introduction. He's like very, let's say, a renowned figure already in the crypto industry and across like also more traditional asset classes. He helms the digital asset research division at VanEck's. And I said back on the show because Matthew already had a great sparring session with me in our Outlook 23. Since this Outlook interview, it's been a wild 1.5 years. VanEck's, honestly, in my view, has been killing it with the Bitcoin ETFs and then all of the bold calls you made and basically hit. Today, with Bitcoin reclaiming the 100K level, I think we will have a super nice discussion. And I'm excited to have you here, Matthew, have you back on the show.
Thanks for having me, Dominic and Laurent. Yeah, it was a lot easier to make those bullish calls when Bitcoin was 25K. So now here at 100, let's see what the future holds.
Fantastic. Thank you, Matthew, so much. You know, VanEck's is an influential player known not just for its innovative ETFs, but also for its forward thinking in the digital assets arena. So currently managing, I think, a little over 100 billion in AUM. I'm really happy to get the chance to, tap your expertise. Matthew, once again, please maybe give us the quick pitch. What's driving VanEck's and VanEck's digital asset research in 2025? And how do you stay sharp in the market that really never seems to slow down?
Yeah, well, we've been around for 70 years, so this is a continuation of a long history of trying to be forward-looking around the evolution of new asset classes. So we were really first to market in the 1970s with a gold mining fund. We were early in emerging markets, equity and debt. The ETF business is now almost 20 years old. And our interest in digital assets really stems from, the fear of the innovator's dilemma. We have all of this gold and gold mining exposure. We are, a macro shop, believe in hard money and traditional economics. And so if Bitcoin, becomes a digital gold, could we be disrupted? And that was the origin of investing in Bitcoin and a bunch of venture investments now 8 years ago. And now today we have close to 25 different digital assets investment products for clients. 3.5 billion in assets, and you'll see continued innovation from us this year. But it really stems from that kind of macro DNA of the markets are always changing. There's always new asset classes that are being born, and we want to design, intelligent products to allow investors to capitalize on that, both active and passive exposure.
Awesome. I guess the market proves that you are on the right side with all the success you currently have, and well deserved. I think we are starting today with kind of a market refresher, I would say. Basically covering everything that happened maybe since the US election. It was like a roller coaster, I would say, since then. As you know, of course, in the last couple of days, we had some kind of recovery. But beforehand, there was this notion of huge post-election sobering, like altcoins dropped, I think, more than 40% from their December highs. Currently, I feel like the Q1 drawdown is more like kind of a late cycle flush, a classic one. And as you know, probably best from the macro perspective, all of these tariff overhangs, at least with the news today, they seem to ease, slowing down a little bit, allowing the markets to go into more risk overdrive again, maybe. And let's see how this trade deal fares with China, and it might also force the hands of the Fed. Maybe there's this notion of an onset of the easing cycle. In your view, like since the elections, what was the most notable, and maybe also what was the most unexpected development since Trump entered the White House?
I think most people are surprised by rising Bitcoin dominance. With the exception of the last week or so, um, that's been the story year to date, and I think it's caught a lot of market participants off guard. We were running the data recently, like the ex Bitcoin part of the market has not made an all-time high in market cap, right? And there's like millions of new tokens. So just do the
Mm.
math, and the average token is down. And what I think now in hindsight, when you look at who adopted crypto since the election and what exactly have they done, then Bitcoin starts to make more sense.
Mm.
So if you look at the corporate treasury announcements, north of 100 companies that own Bitcoin on the balance sheet, you can count the non-Bitcoin treasury companies on one hand, right? Similar with kind of governments and pension funds, we can observe several state pension funds that have started to buy Bitcoin ETFs, a couple of sovereign wealth funds. You're not seeing that in the altcoin part of the market. And so I think that intersection of the energy markets, Bitcoin mining, the de-dollarization trend, they kind of benefit Bitcoin directly, and we can see stakeholders that are actually buying. Whereas in the altcoin universe, it still remains a hope trade, I think, that we can have something approximating mass adoption with tokenization, but still a lot of question marks on whether that tokenization trend will accrue value to the open source databases and the tokens like ETH and Sol, or if after the election, there's more white space for some of these like quasi open source projects. And you can look at the outperformance of like the XRP since the election as maybe one
Yeah.
example of that. So yeah, I hope that answers your question. I think the rising Bitcoin dominance has been the biggest story and maybe one of the bigger surprises since the election.
Mm.
No, for sure. I definitely have to agree with you on the rising dominance, and I think we have a follow-up question to that coming up in a little bit. But since the Liberation Day in the US, Bitcoin has somewhat reinforced its perception as the Swiss Army knife asset and appears to trade on its own demand and supply fundamentals. So according to the latest industry rollup at Bitcoin Suisse, Bitcoin is substantially decoupling from traditional assets on higher timeframes in the bull market. But I'm afraid that it might correlate again strongly in a bear market. Now, are these dynamics sustainable? And what macro signals are you watching to gauge in the next leg up?
Yeah. So I think we have to be careful to call the Bitcoin performance a decoupling because when we look at the data around the daily correlation of Bitcoin in the NASDAQ, Bitcoin in the S&P, Bitcoin and other risk assets, it's still quite elevated. Um, it's really that the down days have been just smaller down days, and the up days have been bigger up days. But in terms of the day-to-day performance, even during that kind of early April period, daily correlation of Bitcoin and NASDAQ remained quite elevated versus the 10-year history, not quite as high as 2022, which scared so many people off. But we're still observing that correlation with risk assets. It's just that Bitcoin's positive skew, meaning that the big up days are so big that they more than make up for the down days. I think that characteristic of Bitcoin has become even more prominent. And then volatility has definitely come down. And when you think from an allocator's perspective, who's running some version of a 60-40 portfolio, and they're thinking about adding 1%, 2%, 3% in Bitcoin, still the biggest pushback I get to that type of strategy is just around volatility. So if you have Bitcoin vol that falls from like an 80% annualized number down to 40%, theoretically that can justify twice the position size from your average allocator. And I think that's maybe where the impact is coming, is that folks who might have capped out at 1% are considering 2% because of the lower volatility. But it's yet to be proven as a decoupling, in my view.
No, that totally makes sense. I mean, there's an alternative point of view that I kind of maybe want to run by you, and maybe you can tell me what you think. But since 2009, the world hasn't really witnessed a financial recession that is sort of systemic in nature and tied to the business cycle. Now, if that is true, then would it also be correct in saying that Bitcoin has not really been stress tested in a macroeconomic recession? So I'm curious to know whether you think, or how you feel about this line of argumentation.
Well, I think that the early part of COVID, that kind of February, March period of 2020, was the market pricing in, very severe recession, if not depression, and Bitcoin fell sharply. And then it recovered once policymakers doubled down on the money printing strategy. So, you can also kind of see that in late 2018, early 2019, when there was the first Fed tightening, and economy slowed down, risk assets were weak, Bitcoin was weak. So, yeah, I think I would push back a little bit on the premise. I think that in a true deflationary environment, when earnings revisions are being cut, financial conditions are tightening, the market's pricing in, GDP declines, every asset goes down because the availability of money is shrinking, cost of capital going up, people getting less bullish about investment. So every asset goes down. Gold goes down the least, but it still goes down, even in like a deflationary, recessionary environment. And, I think Bitcoin still will tend to act like that during periods of weak growth. Then you have, separate from the business cycle, when you have these kind of one-off events like the start of the Russia-Ukraine war or the failure of Silicon Valley Bank, kind of, one-off instances where the market's questioning, is this going to lead to a recession? Or is it more of a shuffling of the deck chairs, a reallocation, but not necessarily recession? And that's where Bitcoin may be starting to act a little bit better as a type of a safe haven. And that's what we saw in early April, for example.
Okay. No, thank you.
Yeah, I fully agree on that. No, that's also what we kind of like. Our views match yours, obviously. I guess a lot of what is currently happening in terms of also central bank reallocation is driven by people are trying to diversify out of more US based assets based on everything that happened in the last couple of months. Let's dive into more, I guess, one of the big topics on your plate, and especially also for Bitcoin itself, is all of these corporate treasury strategies. I guess there are two really mega trends when it comes to demand for Bitcoin right now. The one is basically stemming from public-private companies. The other one, I would say, is maybe not so tangible yet, and it stems more from sovereigns. So what we see currently is that Bitcoin ownership is tilting more and more into this institutional corner. ETF demand is really solid. And there's a large shift in Bitcoin ownership structure, basically from individuals to more professional sectors. Let's say, I think around 14% of the entire supply now is in ETFs, governments, or corporate pockets. As you said before, they're crazy impressive numbers. I checked before, public companies just this year, 160K added on their balance sheet, which is 1,200 Bitcoin daily. Compare that to the issuance, which is only for around 460. So just the demand from the public companies almost triples the block rewards. Now I come to my question. What's the tail risk in approaches like that? For instance, if you think about MicroStrategy now having like a huge part of the Bitcoin supply already in one single entity. There are other people, other entities entering the space. I think VanEck just announced before with David Bailey. There's this merger coming up. We know from 21 Strive around Vivek, MetaPlanet, you name them. So what's the risk? And then in your view, when do we see a Mac 7 integrate a Bitcoin treasury strategy? Or is it just something for bad business model companies?
Yeah, I mean, I think there definitely are risks, and I will give you my view of them. But just as a starting point, when we look at gold versus Bitcoin ownership and divide it into, private individual holders, uh, public companies, governments, funds, ETFs, etc., Bitcoin is still unique for the high proportion of retail ownership. We estimate close to 60% of all the coins still held in private hands. That compares to like 15% of the gold market.
Mm.
If you look at governments own roughly 15% of the gold market. Their ownership of Bitcoin is still de minimis, a couple percent. So funds and ETFs, yes, maybe Bitcoin is punching a little bit ahead of its weight given the success of the Bitcoin ETFs, but there's still quite a long way to go from our perspective before
Mm.
the ownership of Bitcoin kind of aligns with how gold is held. So especially for corporations that are cash rich, but have maybe lackluster growth prospects for whatever reason. The markets that they are serving are saturated. Bitcoin is becoming kind of the hurdle rate for tech investment.
Yep.
So, like in our various DCFs, like as we think about the cost of capital for Bitcoin, in my opinion, it's somewhere in the high teens, kind of 16 to 18% is the cost of capital for, say, a Bitcoin miner. So if you're a tech company and you can't beat 17, 18% internal rate of return with your own capital, then what you can see from the performance of all these Bitcoin treasury stocks is the market kind of saying, hey, have you thought about Bitcoin? It might be a good way to kind of at least tread water with the
Yeah.
broader tech landscape. So I think that's the lesson here is the market, is still open for equities that have exposure. Now, the risk is that the stocks trade at a discount to the value of their Bitcoin, because the business model here so far is the stocks are trading at a premium to the value of the Bitcoin on your balance sheet, so you can issue stock at the current price, buy Bitcoin, and that's accretive to shareholders. Um, if that dynamic reverses and the stocks are trading at a discount to the value of their Bitcoin, then this entire model kind of breaks down.
Mm.
Companies can no longer issue equity, so they're no longer buyers of Bitcoin. And actually, some of the companies might start to sell their Bitcoin and buy back stock, which would close the discount and maybe cause a decent monetary outcome for those shareholders in Bitcoin terms. But that might happen with the price of Bitcoin going down.
Yeah.
So I think many investors in these stocks are looking for growth, right? They want Bitcoin per share to go up, but they also want the companies to own more Bitcoin.
Mm.
And if the stocks trade at a discount, that can't happen. Um,
Did
yeah,
this happen
that's the main
already,
risk.
Matthew, to one of these companies?
Um,
Because I'm not sure.
Not for a long duration. No.
Mm.
So there's, we're tracking like, 10 of these companies and looking for opportunities where um, the stocks are trading cheap to their Bitcoin, not necessarily at a discount, but like if you look at the peer group, why is this company only trading at a 10% premium, but this company's trading at 50 or 80%?
Yeah.
Does that make sense? Why is that the case? Is there a chance it may normalize? So there may be some trading opportunities for the equities. There's one that did reach a discount briefly last week. but not en masse and not for any large amount of time.
Awesome. I guess this also provides an answer to my question around the Mag 7. They're probably
Right.
like performance-wise just still too strong in terms of like them being like a very profitable tech companies. And maybe then once your threshold hits, it makes sense to consider like these treasury strategies. Would you agree?
Well, I would almost count SoftBank as a Mag 7. If you look at
Really? Okay.
performance of SoftBank equity versus the Japanese market over the last 3 decades, Masa has created a ton of shareholder value by consistently being early and large on the biggest tech trends.
Mm.
So he made his initial Bitcoin investment, I think it was 2017, 18. He sold it almost right away for a big loss, changed his mind, and now coming back into the market with this Tether JV, a much larger size, be harder for him to change his mind. And Bitcoin now is kind of a low single-digit percentage of the SoftBank net asset value.
Mm.
And I think this time Masa understands the synergies between Bitcoin and AI. And that's why he also has purchased 3% in the common equity of Cypher, a publicly traded Bitcoin miner who's trying to land an AI infrastructure deal potentially with Stargate, which is that OpenAI SoftBank JV. So yeah, Masa has a lot of irons in the fire right now, and I would count SoftBank as a kind of little sister of Mag 7 and what it has. So I mentioned earlier, like Bitcoin is most appropriate for cash-rich, low-growth companies, but also founder-led companies where one person can make a decision, controls the majority of the shares or the majority of the voting power. And SoftBank ticks those boxes. So if you look at US Mag 7, so there's some companies I would maybe rule out, like Google and Microsoft. I think will be very unlikely to be buying Bitcoin because of the governance of the firm and how diffuse the ownership is. But then other names like Meta, or if you add Tesla to the mix, where founder still controls a big percentage of the company and can kind of make those decisions, I think the odds there are higher at some type of Bitcoin strategy. Maybe not a fully leveraged 100%, but token purchase.
Mm.
No, wonderful. I think that's really, gives us some really good insight. I didn't personally think of that. So yeah, that's definitely, I think, the power of having you on the show as well. I wanted to maybe switch gears and talk about the new fund on the block currently being introduced by VanEck called Node, which is focusing on providing exposure to equity investments, actively engaging in blockchain technology with an added dose of BTC for good measure. The total investable universe, correct me if I'm wrong, but it's approximately 7.5 trillion in size. So we're looking at something more than double the crypto market capitalization, providing broader exposure in a mature market with deeper liquidity, scale, and lower volatility. So maybe, Matthew, can you please share with us some details on the rebalancing mechanism? I know that it's ad hoc, but do you see Bitcoin's 4-year cycle guiding the rebalancing schedule? Is it going to be more cyclical or ad hoc?
Yeah, so maybe I'll just kind of give the genesis of this product, which is in talking to institutional investors, advisors, even kind of boomer retail investors, we have found that the volatility of Bitcoin is the single biggest pushback that people have.
Okay.
And even when they kind of theoretically agree with Bitcoin's value proposition and admit that kind of dollar reserve currency, maybe deserves some type of hedge and Bitcoin, can fill that hedge, we still just sense pushback from investors who don't want to struggle through these 70% drawdowns and then face a decision of whether to buy on weakness, which is very hard to do in a 70% drawdown if you're not Bitcoin native, or sell out. And so as we look at the universe of the crypto equities, they actually have higher volatility than Bitcoin, right? Some of these Bitcoin miners, they trade at twice the volatility of Bitcoin itself. So that compounds the issue for the traditional boomer investor who wants to own securities, wants the protections of a traditional corporate governance, wants to be able to follow the news flow through the quarterly earnings cadence and company conference calls, investor relations materials, all the things that you don't get with Bitcoin and tokens really, but you do get in the crypto equity universe. Then they get, oh my gosh, like I have to buy these Bitcoin miners and their volatility is twice as high. So our idea is that if we define the investment universe to include any company who has a strategy to make money from Bitcoin or digital assets, and that can include buying the tokens for treasury purposes, that's at the very high volatility, range of the universe. Bitcoin miners, of course, exchanges, pure plays like, the Coinbase, but also hybrid players like Robinhood or like an eToro who's about to go public and has a big crypto exchange business. And then we can even include some of the infrastructure providers. So there's a number of energy companies, energy pipeline companies, even downstream utilities who are selling electricity into the Bitcoin mining ecosystem. And you start to read their SEC filings and their conference calls and look at their investor relations materials. There's more and more mentions of Bitcoin. Companies are no longer afraid to divulge that Bitcoin miners are becoming a material part of their customer base, and that now with the intersection of Bitcoin and AI, those lines are blurring, and it's causing a lot of upward revisions for these utility companies. But the volatility profile of some of these stocks is so much lower than the Bitcoin and Bitcoin miners that when you combine them together, I think we can manufacture a portfolio with a volatility profile that's going to appeal to that more cautious, long-only investor who wants to hedge that they may be wrong about the U.S. dollar, that maybe U.S. exceptionalism, could fade because of Bitcoin dominance, not even because of anything that the U.S. does wrong. And they want a diversified portfolio that is exposed to that theme at a lower volatility and where the fund and the fund manager has some dry powder in order to deploy into a period of very high fear and uncertainty, because we are at heart Bitcoin bulls. So to answer your direct question, sorry for all the background.
No, it's great.
I think it's TBD about the Bitcoin 4-year cycle. I think that all things equal, we would tend to be a little more cautious in something like a 2026, which if the 4-year cycle holds, would be, a challenging year for Bitcoin. But that's going to depend on other factors such as monetary policy, and then just price action, right? We want to have this dry powder in lower volatility equities so that we can deploy into Bitcoin and Bitcoin miners when there's a period of max fear. We're definitely not in a period of max fear right now. So on day one, I think investors can expect more of a balanced portfolio.
No, wonderful. Thank you. I think it's something that's super exciting, and I think it really goes to prove the innovation that's happening at VanEck. Where do you think client demand right now is the hottest? Is it still the Bitcoin ETF, or has there been more attention placed on Ethereum since last week's spike in price?
It's still the Bitcoin ETF.
Okay.
So right after the election, I did a call with like 500 registered investment advisors, huge call, and 48% of them had zero Bitcoin ETF exposure for their clients. And so my kind of inbound phone calls have picked up materially since the election. Last week, I was at an event where it was a partner client of ours who recently added Bitcoin ETFs to their platform so that their advisors can now insert the Bitcoin ETF into client portfolios without a reverse inquiry. And that is a real game changer. So most of the big banks and brokers that are allowing clients to own these Bitcoin ETFs, many of them still will only allow it for reverse inquiry, meaning the client has to call their advisor and be like, hey, I know you're running this 60-40 portfolio, but I please manually override. I want 1% in Bitcoin, and then they can add it. Now, at this partner, Stewart Advisors, 40 billion AUM asset manager, their advisors can now put the VanEck Bitcoin ETF and others into the client portfolios without asking. And the feedback that I got after that event was that really will turn on the spigots for these advisors. So, I like that we are still early. Like, I can confidently say that we are still very early on advisors integrating Bitcoin into the portfolios. On the Ethereum question, I did get a lot of what I call contrarian sell signals in the last couple weeks from clients who are indirectly allocated to Ethereum through some of our private funds, and we're just very concerned that Ethereum would die, and so some of those emails kind of directly mark to the bottom. So yeah, we do still have some ETH exposure in the ETH ETF, but also in some of our private strategies.
No, I think I think that kind of always signals, hey, the bottom is in, when people are getting a little bit out of hand with their selling action. But no, thank you so much. I think that was really exciting.
Yeah, I guess this will forever be true. Kind of when you really start, like when it scratches your conviction, you are close to the bottom, most likely. I think it's incredible what you said with the volatility on the Node product. I'm like super excited to see how you tweak it in a way to have a lower volatility than Bitcoin. I'm also like still impressed that the whole notion around Bitcoin's volatility is one of the major discussion points with more professional investors, especially given that volatility came down so much. We have like Vola is probably like below a lot of the big tech stocks, for instance, but for them it's somewhat fine. For Bitcoin, I feel like not so much.
No, that's a very good point. It's like, it's going to be hard, candidly, to get the portfolio vol lower than Bitcoin, because it's the mining companies that really, have very, very high volatility, and Bitcoin actually lowers the vol of if you have a portfolio of just the pure plays, Bitcoin will lower the vol. When you include some of the fintech and midstream and downstream utilities, that can really help balance it, though.
Yeah, I guess you need to balance it out with very low volatile kind of equity or positions. As I said, like I'm excited to see the product being live then. Also, in my view, honestly, like we are past 70% drawdowns. I don't think it will happen again. I'm like, honestly, but also like I'm happy to be wrong there, but I don't think this is like we will see another 70% drawdown. Not sure how your view is, but it kind of tells me that we still have like there's still a lot of let's maybe not lack of education, but we still have to be out there, kind of explain the entire characteristics and the developing profile of Bitcoin, how it behaved in the last couple of years, how it's maturing. I guess the perception is still a little bit skewed, maybe towards the bad side, let's say. I would like to shift gears into maybe the sovereign part, digital gold part, kind of. We know that sovereign accumulation of hard assets is quite on a super high pace when we think about China or like a lot of the BRICS states, like in terms of relative allocation into gold is like climbing across the last couple of years. And I feel like it also caters somewhat to Bitcoin. We know there's this strategic reserve asset executive order from Trump. We are waiting for the one of the evaluations. I think the deadline passed already. I did not see any news on it. Where I want to go with this is kind of, there was this notion, I think you also posted about it. We know like the US has like huge gold reserves, right? And there's this theory of, hey, what happens if they value gold mark to market and not with this mark to model accounting? Because the executive order like mandates that you can only allocate in a budget neutral way. So if this happens, for instance, we get like an increase of 900 billion. We are not too far. It's not too crazy to think, hey, they might allocate like 100 billion in a budget neutral fashion. At the same time, if you check the gold chart, it seems like very bubbly, let's say. So there's also this notion of maybe gold is in overvaluation territory and maybe some capital rotation in its digital twin makes sense. I guess my question to you is, in this kind of increasingly fractured monetary regime, where does Bitcoin fit in this kind of hard asset pivot? I guess you should be one of the experts in this. And then maybe if we think about like this notion of a waning dollar reserve status, can Bitcoin outshine gold? Like, is this something that might be possible, or are we getting ahead of ourselves here?
I mean, I think the trades are two sides of the same coin, which is gold and Bitcoin being the best plays on de-dollarization, deglobalization, fragmenting and reorienting of global trade and capital flows to the detriment of the US dollar. And that's thesis has been playing out. US dollar foreign exchange reserves are at 30-year lows. The use of the Chinese RMB is at an all-time high on the SWIFT network. The GDP trends in the UK and the EU and Japan all predict major market share loss of global GDP from some of those major G7 currencies. The BRICS economies are now bigger than G7 economies on a purchasing parity power basis. And Bitcoin, I think, is the clearest beneficiary of that, to the extent that countries are going from 0 to 1 on their adoption of Bitcoin. So the parabolic just market cap returns have the potential to be the largest. And one example of that 0 to 1 is Russia and China now settling a portion of their cross-border energy trades in Bitcoin, thereby circumventing the US dollar. Bolivia's state energy firm also announced that they would use crypto to pay for energy imports, although they later backtracked on that. So it's a little unclear where that's going. But the number of countries that are mining Bitcoin with government resources has nearly doubled year over year, and we're tracking that carefully. And most of the new countries are in debt with the IMF and need to roll that debt. So they see Bitcoin as a negotiating tactic, a way to restore sovereignty over their own printing press. Similar to how countries often use gold mining, right? Where the gold mining firms are often quasi-state owned in some emerging market and frontier nations and used for their access to hard currency. So that is, I think, one of the big stories of our times. It's one of the reasons why Bitcoin was invented, and it's a very strong trend. What was the second part of your questions?
If Bitcoin is able to outshine gold at some point.
Right. So about half of gold market cap, or half of gold demand, is used for jewelry every year. So the other half is a speculative expression. And if you take half the market cap of gold, that would equate to roughly 500K Bitcoin price. So I'm not making a prediction of future returns, but a lot of people kind of look at that as a key benchmark of when can Bitcoin reach half of gold's market cap, because half of it is speculative in nature.
Okay, that's interesting. I didn't know. I thought actually at least like industry use is way lower, right? It's like around hovers below 10%, I think. And then
it's more than 10. It's more than 10%, right? And then we're not counting jewelry as a speculative, although there's an argument where you could, right? But industrial plus jewelry is roughly 50%. The other 50% is obviously, speculative / store of value by governments or fund
monetary
buyers.
premium, yeah.
Exactly.
Okay, awesome. That's a cool perspective. I guess I would like to pick your brain on Bitcoin mining a little bit more because you mentioned it earlier. I think the last number I saw is like around 40% of hash rate is still sits in the US compared to international mining efforts. You mentioned this whole topic AI infra x Bitcoin mining. Maybe you could give us a little bit more insights or explain like M5, how are these like interconnected? And then the second perspective I would like to touch is I know we might be a little bit early, but I would love to get your take on it. It centers around Bitcoin security budget. Last couple of days it was like all over the place again. There's very little transactions, super low on-chain activity on a like above 2 trillion asset, which is a little bit, it provides some headache, let's say, because after 15 years, Bitcoin didn't manage to make its block space pristine. You know, like there's nobody transacting on it. Of course, its narrative like shifted into this digital gold now, not anymore the payment network. There's a couple really cool efforts on the layer 2 side. I know Starkware, super legit project. I think they are like very close to making something big happen. OPCat, it's still not clear, but I think latest in two halvings from now, I would say we have to face the elephant in the room and discuss like what is happening with mining rewards and what is happening with the mining industry, like how sustainable is mining in the long term. We know there's only like a little bit more than 1 million Bitcoin to be mined. What about the transaction fee? Like, could sovereigns maybe subsidize mining to control hash rate? What's your take on this like incredibly important topic that is not covered, I feel?
Yeah, I agree with you. And I think maybe the two questions are connected. So taking the Bitcoin mining and AI first, the obvious connection between the two is that they're both incredibly energy intensive. So the largest single input to cost of goods sold is electricity, and to the extent you have a low electricity prices, that can mean the sort of difference between survival and bankruptcy. So that's on the kind of cost of goods. Then you have the industry dynamics. So two pretty early stage industries that have fast growing demand profile, but also extremely volatile. So when you're looking to fund yourself in the capital markets, it's hard to do that with just equity. Very expensive for Bitcoin miners to just fund themselves with equity. When you combine AI and Bitcoin using the same feedstock, which is electricity, now you've suddenly diversified, and you have an end market where you're facing off against two fast-growing but volatile industries. And that should, for the miner, kind of smooth out the revenue stream a little bit and make it less volatile. And then the capital markets are very willing to fund AI infrastructure in the debt markets. They're not very willing to fund Bitcoin miners in the debt markets. So it's really brought down the cost of capital for Bitcoin miners and caused share prices to increase. And when your share price is higher, that gives you a lot of flexibility to make acquisitions or raise other financing. So we kind of identified quite early that the AI story would be a tailwind for the Bitcoin miners that were most nimble and aggressive. And I think that's really been reinforced through the messaging at the White House. You rarely hear President Trump mention Bitcoin without mentioning AI in the same sentence. And that's because I think he understands that if the US is dominant in Bitcoin mining, we will likely also be dominant in AI and energy infrastructure at the same time. And that's where the connection makes a lot of sense. As for your comment on the security budget, Bitcoin fees as a percentage of the rewards, I think made another all-time low last month. Like it's 1.5%. We got as high as 15 to 20% during the ordinals and the runes booms, and that entire traction has faded. So, using Bitcoin to pay for coffee, things like that, that would really be a high velocity kind of microtransaction payments platform and cause enough of a fee stream to make up for these declining block rewards. That story or reality has not materialized. I think it's part of the reason why the miners are accelerating to diversify into AI. I do think it's an issue, to think about in the next decade. I don't think it's material to the current cycle price action,
No.
but we're going to start to see, more people talking about a tail emission or inflation rate or some way to catalyze transaction higher frequency. And there, I think you just have a structural issue where merchant acquirers, so payment companies who want to onboard merchants to use a certain rails, that business needs a sales force that's highly motivated and gets paid on performance. And like Bitcoin is different from that. It doesn't have a sales force. Many of the L2s, have their DNA more among the Bitcoin whales than they do at the storefronts. And that's something that needs to get sorted and change for Bitcoin to realize its full potential. But I don't think it's going to matter for this cycle.
Yeah, okay, fair enough. So we kick the can down the road a little bit further. But I feel as the asset grows and grows, it's like, I don't know, there's this like elephant in the room, and then at the same time it gets bigger and bigger, and I feel like we need to take care of this at some point, or like start a discussion. I guess there was
I
this
nominate
cool...
you to put in the BIP, whatever it is.
All
I
right.
nominate you.
There was also this cool theory, like quantum threats are becoming more tangible. And we know like there's a lot of Bitcoin that wasn't moved since Genesis maybe, or very early days. And maybe at some point there might be, we might be forced to at least soft fork. And there was this notion like you have to protect these addresses. I don't want to dive too deep into the technical weeds, but one outcome could be that you use basically all of these non-moved Bitcoins in order to have more block rewards at some point. And then it's interesting because you would have like, I don't know, at least like 1.5 million more to issue or redistribute. But obviously it will open up a huge debate.
I mean, that's kind of what the Satoshi wallets are there for, is like to encourage white hat hacking to make the protocol more resilient. But that's one of the things I think that you might see like in this new fund that we're launching, where we might include some, there's a couple of kind of quantum computing equities that might be eligible for this type of strategy, and you can think of them as maybe like a hedge on quantum success, right? Where you might want to own a small position in a pure play quantum stock alongside your Bitcoin to balance out some of those risks.
Yeah, that makes sense. Maybe in this regard, one last question, because I feel it might be very insightful for the audience. We know like Bitcoin mining usually runs on ASICs, right? Like these application-specific circuits. And now we also know, or one knows, AI compute usually runs on GPUs. Well, that's what the broad public perceives as such. Can you link these two? Like are Bitcoin miners, once they hit the AI industry, are they less efficient then? Or how do ASICs fit into this AI compute demand?
I think that as zero knowledge proof based applications become more widespread, that's where you might see a bigger impact in the kind of semiconductor world. So Bitcoin's still very inert, and there's not that much you can do with the network. So the ASICs, I think, have less applicability into like real world applications. Whereas to enable zero knowledge proof based apps at scale, you need a lot of ASICs. And it's possible over time that design gets standardized. Even maybe AI helps design some of the standardization that occurs. and maybe something that's now a low volume ASIC becomes a next XPU, right? I don't know what that exactly is called, but it could be a new format of chip that is totally, mass market and scales in a way that ASICs don't. But that'll, like, going back to our conversation on ETH and some of the altcoins, that'll depend on if we see mass adoption of the truly open source database assets. So, like, you made a Linux analogy, and while it's true that Linux itself kind of open source, no one makes money directly from the Linux kernel. There were companies like Red Hat, which was publicly traded and purchased by IBM, multi-billion-dollar company that just existed to maintain instances of Linux and support those instances for corporate customers. And the Ethereum token, I think, is more like that, and the Ethereum virtual machine is more like a Red Hat than it is like a Linux exactly. And then the question mark since the election and like the outperformance of, say, an XRP is like, well, maybe it's actually a private company that benefits most from this if they can use their expensive token to buy a real business, like Ripple bought Hidden Road, which is a prime broker, and then they're going to force those customers to use the XRP token. And even if it doesn't have as much like native programmability as ETH and the Ethereum virtual machine, they'll be able to basically force customers to use it. And I think that's still one of the big open questions around these open source databases. And Trump's regulatory light approach maybe caused Ethereum's decentralization premium to be slightly less valuable, and that's maybe one reason why it's underperformed.
Good take.
That's a nice one to segue back into Ethereum. I mean, Bitcoin somehow steals all the limelight, and for good reason. But I will stand up a little bit for some of the Ethereum maxis out there and maybe just ask a straightforward question. Ethereum staking index, do you think it will bring in some more institutional flows?
So you mean once the SEC approves the ETFs for staking?
Agreed.
I do. And I think part of that will be that will come together with the transition from these ETFs to be created with just cash, and instead they'll be created in kind, which means that the market makers and the brokers will actually be touching Bitcoin the asset, ETH the asset, and not outsourcing that to a foreign subsidiary.
Okay.
And once the US regulated broker dealers are touching those coins directly, I think that they will come up with more strategies to hedge that exposure, and that will catalyze more adoption.
Okay.
I think, sorry, Laurent, I think this
Sure.
was, I just read this 1 hour ago, that BlackRock at least filed for in-kind redemptions.
I think they met with the crypto task force last week, and that was one of the conversations that they had. So it's definitely coming, right? SEC's delayed that now a couple times, both in-kind creation redemption and staking. But the task force has been heavily engaged on that. So we would expect, certainly by the end of the year, that both of those things will happen.
No, nice. I think I'll pick it up and ask the question of the current Stable Act, since we're on the topic of regulation. So the Stable Act is currently running in the lead for voting in the House of Representatives. As a primarily federal approach to regulation, the Act requires stablecoin issuers to sort of adhere to some operational standards, by obtaining a banking charter, implementing AML, KYC regulations. Is the regulation sort of legitimizing the issuance of the dollar-based stablecoins, and do you see it as a win for the industry overall?
Yeah, I think I would characterize it as saying that you do not have to be a bank holding company to be a stablecoin issuer under this new regulation, and that's a huge change, because just think back to when Facebook was trying to start Libra, and the main pushback was like, hey, why are you trying to be a bank? That's not allowed. And then version 2 with the Biden opposition was, okay, maybe you can be a bank like Anchorage Digital, right? Qualified custodian, but you need to be federally chartered. Oh, and by the way, we're not going to give out any more charters. Now we're in this new regulatory light environment where you don't have to be a bank. So we're going to see tech companies who will be able to file, and you don't have to be federally chartered. So there'll be some minimum standards that will be at the federal level, but a state chartered bank or non-financial institution should and will be able to issue a stable coin if this legislation passes. And I think that's a big win for tech companies and for the consumer.
No, fundamentally true. I fully agree. I think in addition to that, they've also said that algorithmic stablecoins are on a moratorium, which I think is prudent given the history of algorithmic stablecoins.
There's still hope, I would say. But let's see. I think like what we currently observe, I guess just this week was super heavy on news. When you think about Meta, as you said, they're back in the game. Also, Stripe, I think, launched their their stablecoin accounts across 100 countries. And I think what you just said is incredibly important when you think about banks, because kind of it really challenges the business model of banks at the very source, which is deposits, right? So They kind of have to feel the heat right now. So let's see how they respond in the next couple of months. Let's dive into something spicy. It's like a new element on Verified, and it centers around a sample portfolio. I just had this in a recent interview myself, and I thought it was quite stimulating for the audience. So say hypothetically you had to build a portfolio, say with 100K. How would you balance that with the options you currently have on chain? Obviously no financial advice.
Yeah, definitely no financial advice. And I think like giving advice like this, it really depends on the client's end goals. So when you're a fiduciary, you have to consider the suitability of the investment and what is the client trying to achieve. So there's no one size fits all. So I'm going to be very cautious then as I respond to this question.
I'm asking you.
Yeah. I still think 50 to 70% of an on-chain exposure should be just purely to Bitcoin. And then no other single holding should be more than 5% of the remaining. So call it 65% Bitcoin, and then the other 35% would be spread across either, a number of L1s like ETH and Sol, or just put into a fund. And if you want to go high risk, then you can allocate to like VanEck Ventures, which is a early stage seed and up to Series A, traditional venture capital approach. Trying to find the next billion-dollar company at seed. A lot of these are going to be zeros, and maybe one or two returns the fund. And that would be the high volatility, low liquidity approach. Or you could consider a fund like Node, which is not tokenized yet, but maybe we'll find a listener on here who wants to tokenize it.
Nice.
And that would be like a lower volatility approach, but still diversified. So I guess my conclusion here is like BTC really is unique because of the security, because of the proof of work, because of the adoption at the corporate and sovereign level. It's been de-risked in a way that none of the assets have, and so the balance of your portfolio should be diversified into funds or small token positions.
Awesome. That was a super good answer, Matthew. And the reason why I'm asking is like, I guess we all follow this vision of maybe one day we can manage our entire portfolio out of our wallet, right? And maybe have a different set of liquidity. If you think about maybe I have some tokenized treasuries, but can like with an instant, with one click, liquidate them swap them into an ice cream or something like that. That would be nice.
I mean, I think the main question there for the investor to answer themselves is how much time do they want to be allocating to this?
Yeah.
Crypto is such a fast-moving industry, and if you're going to own, 20, 40 different positions, you really need to be paying attention to them every day, every week. And most people don't really want to do that. I don't even want to do that. And I'm a professional, right? Who wants to be changing their mind every day? It's not a very pleasant place to be. So, in answering a question like this, I want to try and set something where someone can stick with it for a long amount of time and not get shaken out when the volatility is the highest.
Yeah, great. I fully agree. Thanks, Matthew. It was a pleasure having you on the show.
Great. Thanks.
Matthew, thank you so much. Really appreciate it. It was really a fantastic session. For the audience, check the show notes from VanEck's research and Matthew's X handle at Matthew Sigel for his real-time takes. Subscribe, rate, and review. Keep verified at the top of the charts. See you next time. Stay verified.